Hello, in this video we're going to be looking at aggregate demand. We'll be talking about the various components that make up aggregate demand, as well as the things that cause the curve to shift. Now in this case, when we say aggregate, we're just looking at the economy as a whole, the demand for all goods and services in the economy. To keep consistent with some of our other models, we're going to be talking about consumption, investment, government spending, and net exports. So the components of aggregate demand are going to match what we see in real GDP and also in our aggregate expenditures model. So aggregate demand reflects the demand for all goods and services in the economy given various price levels. We're still going to end up with that downward sloping demand curve, showing that as prices drop, people want to buy more stuff. As prices go up, people want to buy less. So same thing as we did way back in chapter 3, like 3 and 4. When the price decreases, the quantity demanded increases. This is true whether you're talking about demand for a specific product or we're talking about aggregate demand in the whole market. Prices increase, the quantity demanded decreases. So quantity demanded refers to a particular point on the line, and just like in earlier models, price changes just cause you to move from one point to another point along that same line. So aggregate demand is created by the demand for consumption goods, investment, government spending, and net exports. Similar to our formula for real GDP, right? C plus I plus G plus X. Aggregate demand represents what the real GDP will be at different price levels. So it tells you how real GDP is going to change as the price level changes. Aggregate demand is that relationship between real GDP and prices. We're only going to have one actual real GDP in the economy, but if prices go up and down, it's going to affect what that real GDP actually is. So just like in an individual market, lower prices mean higher quantity or higher real GDP. And in this case, because aggregate demand is the total for all goods and services in the economy, the quantity demanded is directly linked to the real GDP. So you could say as the price drops, the real GDP increases, or as prices go up, real GDP goes down. So we're going to have a downward sloping aggregate demand curve, meaning as prices change, the quantity demanded or the real GDP goes up or down. And so we're going to look at a couple reasons why. So things that cause a movement along the curve. Why would we have a higher real GDP when prices drop? The first reason is the wealth effect. Changing prices affect the real value of household assets. So an asset is something that a person or a household owns that's of value. So let's say you have a cell phone. This would be an asset. It's a valuable item. A house could be a valuable item. A car, even cash in your wallet. If you have $5, that could be an asset, right? It's an actual thing that you own of value. And so the wealth effect says that when prices change, it affects the actual value of those assets. It affects the value of the things that you currently own. So prices falling increase household wealth. Prices rising decrease household wealth because the assets you have are fixed. The value is already determined. It's something you currently own. And so when prices of other things change in the economy, it affects your relative overall wealth. And in this case, when we say wealth is the value of all the stuff that you own. So your checking account, your house, your phone, all of the things that you have. And so when prices change, it's going to affect household wealth. There's also going to be the interest effect. So when there's changes in the price levels, it actually affects the interest rate. Lower prices reduce the demand for money and therefore lower the interest rate. Now, we're going to talk more about the demand for money in a later chapter, but the idea is that when prices are high, we need a lot of cash to be able to purchase things. When prices are low, we need less cash. And in the money market, as the supply and demand for money changes, it affects the interest rate. Lower interest rates reduce the cost of investment in capital and building new homes, and also leads to a higher quantity or a higher real GDP. There's also the international trade effect. So we've got changes in the price level affecting the relative prices of imports and exports. Lower domestic prices make imports more expensive and exports cheaper. Higher domestic prices make imports cheaper and exports more expensive. So when we're talking about movements along the aggregate demand curve, we're only referring to things that change the price. We're going to see in a couple of slides how we have some changes in imports and exports and how that can actually shift the curve. So when you're trying to figure out, is this a movement along the curve or a shift, really think about, is it the prices, right? What's happening with prices? If it's something affecting the price level, then it's going to be a movement along the curve. When you're talking about an entire economy, the price level oftentimes has to do with inflation, right? So it's the general price level in the economy. We're not talking about individual prices going up or down. So if it has to do with prices, it's a movement along the curve. As we're going to see later, other things are going to shift the entire line. So here's what our aggregate demand curve looks like. It's a downward sloping curve, just like our regular demand curve from chapter 3, individual market demand. Here, instead of prices, we have price level. This is going to be some sort of price index usually. And in this case, our base year price is 1. So 1.14 at point C means we've got some inflation, right? 14% inflation. Okay, so this is representing a price level. And down here on the x-axis, instead of quantity, we've got the value of real GDP. So it's going to be a dollar value, but it's representing quantity because it's representing how much stuff would be produced or purchased as the price level decreases. So we could see here at point C, we have a price level of 1.14 and we have a real GDP of $12,000. This is in billions, so this would really be $12 trillion. Let's say prices drop. So our price level goes from 1.14 to 1.12. So generally, all prices in the economy are going down. This moves us to point D, where we would be at a real GDP of 12,100. Prices drop a little bit more, down to 1.10. Then we'd be at point E with a real GDP of 12,200. So even though down at the bottom is a dollar value, it is representing quantity. And the reason we have to convert it into a dollar value is because this is an aggregate market. We're looking at the value of all goods and services in the economy. And so if we just converted this to a quantity, it wouldn't make any sense. So if we have, let's say we have an economy and we have 10 pizzas and 30 cars and 20 hats, and we would just counted this as a quantity, we would say the quantity in our market is 60. Let's say things change. Now our pizzas are at 30, cars are at 10, and hats are still at 20. You would still say that the quantity is 60, right? We're producing 60 things. The problem is when you're looking at the value of this, the value of our second economy is much lower because the value of a car is much less than the value of a pizza. At least it is at the time when I'm recording this. So we want to convert these into dollar values because we're seeing the value of production. And because this is the market for everything, we are purchasing, or consumers are purchasing things relative to all the other stuff they're buying, right? Same with government and imports and exports. We can have a table. So here up on the right-hand side, we have a table. So showing point A, B, C, D, and E. We've got the price level. And we have the total aggregate demand here, all the way on the right. And so the points that we're plotting are the price level and the total aggregate demand. We can split aggregate demand up into each individual component. So we've got consumption, investment, government spending, and net exports. And so you just take these values and then you add them all up, and then get aggregate demand. In this model, our government spending is going to be constant because it's not going to be affected at all by the price level. Government spending in this instance is going to be considered autonomous. It was determined in some other year outside of the model, and it doesn't change based on the price level. But as you can see, consumption and investment and net exports all increase as our price level drops. So as price drop, the quantity demanded increases. Okay? In this case, it's a dollar value. Real GDP in our economy is going to be determined by aggregate demand and aggregate supply. So we are going to get a market equilibrium. We'll see that in another video. In the aggregate supply video, we'll talk about market equilibrium. And they interact, right? Supply and demand have to agree with each other to be at a market equilibrium. So we have this entire set of options for what our real GDP can be based on our consumer, investor, government preferences. And once we add aggregate supply into the market, we'll see what level of real GDP we actually end up with. So let's talk about things that are going to shift the curve, okay, or determinants of aggregate demand. Why is it on that particular line? Why is consumption at 8,500 when the price level is 1.14? Or why is net exports negative 540? All components of GDP are considered determinants of aggregate demand. These are all part of the market conditions that determine those different starting points, that determine sort of where that line ends up. So consumption, investment, government spending, and net exports. If we get a change in any of these components, it's going to cause the aggregate demand curve to shift. So let's say we have some sort of change in consumption. The preferences of our buyers are changing in a particular market. One thing that often affects consumption is consumer confidence. So how consumers feel about the future affects how much they're willing to spend today. If we have low consumer confidence, that can shift the curve, right? It's going to be at a different place than if we have high consumer confidence. If we have a change in the price level, so inflation or deflation, we're just going to move to one point on the curve, a different point on our aggregate demand curve. Just like we did in our market for Coke, people have different reservation prices. The lower the price went, the more people entered our market. So changes in price level will not shift the curve. Changes in any of these components of GDP or the components of aggregate demand will shift the curve. So a shift to the right means we have an increase in demand. That's our first graph here. Shift to the left, that's our second graph, or the one on the right, that shows a decrease in aggregate demand. An increase in demand means that at every single price level, we're going to have a higher quantity of real GDP, higher value of real GDP. Decrease in aggregate demand means at every price level, we're going to have a lower quantity. Okay, so let's talk about some of the categories and things that might potentially shift aggregate demand. Consumer confidence is one of the biggest things that affects consumption levels. This is consumers' expectations about the future. When consumers are optimistic about the future, they're going to buy a lot more stuff today. They're going to buy more cars, they're going to buy more furniture, they're going to buy more clothes. It doesn't even matter if they're correct, but if they think the economy is going to be doing well, I'm going to get a big raise at work, I'm going to be able to get promoted, 5 years from now I'm going to be making a lot more money than I am today, I'm going to spend a lot more money now, just on stuff, on everything. If I'm concerned about the future economy, I think maybe there's going to be a recession. I'm not sure how, if my job is going to be secure. I don't really trust, if you don't trust whatever government just has been elected, you might decrease your spending today. You don't have a lot of confidence. You have a lot of concerns about the future. Consumer confidence is something you will hear from time to time in the news. It happens, or it's reported a lot during holiday seasons where we usually have high levels of shopping, because it's one way that businesses sort of try to predict what people are going to spend. And it doesn't matter if we're correct about our expectations for the future, it just matters what we feel. Household taxes are also going to shift aggregate demand. This affects the consumption portion as well. Taxes affect disposable income. Right? If you remember from our national accounts slide a couple chapters ago, disposable income is the money that people actually have to spend. So after taxes are taken out, how much money do you have left? If taxes go up, you're going to have less disposable income. You're going to spend less money. It's going to decrease aggregate demand. If taxes drop, you have more disposable income, more money to spend in your household. Aggregate demand is going to go up. So raising taxes shifts aggregate demand to the left. Lowering taxes shifts aggregate demand to the right. Household borrowing is going to affect consumption. Borrowing is going to increase aggregate demand. Why? If I'm borrowing money, I have more money to spend. I'm going to demand more goods and services. I'm going to be consuming more stuff. When households pay off debt, this actually decreases aggregate demand. Sometimes you'll hear things in the news talking about how the U.S. consumers have, $1.6 trillion in credit card debt. Borrowing all of that money, spending all of that money on a credit card actually stimulated the economy. It increased aggregate demand. If people start paying off that credit card debt, that means we're not spending money on new things, which means the real GDP, or the value of stuff that's being produced today, is going to go down. It's going to decrease aggregate demand. Sometimes, especially if your economy is going into a recession, you don't want people to pay off debt because that can exacerbate a recession. However, as an individual household, as an individual family, it is good for you to pay off debt. And so the things that we might need to do on a group level in the short run may be different than what's beneficial for us individually as a long run. We can have shifts in aggregate demand because of changes in investment spending. This could be new production or purchases of capital goods, technology, any kind of new home construction. Investment spending here is not talking about the stock market. This is not any sort of financial investment. This is investment in physical products that change productive capacity, and also new homes. Business taxes are going to affect investment spending. So if business taxes go up, then investment spending is going to go down. Business taxes go down, investment spending is going to go up. Okay, just like with household taxes, the higher the level of tax, the less money there is available for people to spend, and then aggregate demand will decrease. Investment choices are often based on expectations of the future, especially considering how long it takes to produce capital goods and new technology. It can't usually happen in real time. So it can't just be like, oh, there's a high demand for something. This could make a lot of money. I'm going to build it. It's going to be ready today. There's planning and inventing and licensing to get, often copyrights. If you're building a factory, it could take several years. And so investment choices have to be based on expectations about the future. This includes things like expected returns. How much money am I going to earn on this investment? I want to be comparing not just am I going to be making a profit or a positive dollar amount, but could I be making more doing something else instead? What are the future business conditions going to be like? Is our economy heading into a recession? Is this a good time to launch a business? If the economy is about to go into a recession, it might not be a great time to start a new business. You're going to have a lot of inventory and products and no customers. If the economy is close to the end of a recession or coming out of a recession, that might be a really good time to start a business because demand is going to be ramping up and you'll have a lot of customers. What technology options are available or going to be required of my company in the future? How much excess capacity do I have? Can I easily ramp up production and make a lot more stuff if I have high demand? Am I running my machinery in factories at full speed? Do I have a lot of inventory available to be able to sell or that I need to sell off? And so all of these things that I think are going to happen in the future are going to affect my investment choices today. So let's say we have changes in real interest rates. Okay, so this is not changes in nominal rates, and this is different from the interest effect. So the interest effect we saw on the other page was talking about how price changes affect the demand for money, which affect interest rates. Here, when we're saying the change in real interest rates, we're talking about either the cost of investment or the return of an investment. So real interest rates determine part of an investment's profitability. There's the cost of borrowing. There's also an opportunity cost of investing versus saving. So you may be paying an interest rate on a loan to start a business, or you may be losing out on a savings rate by investing in something or creating a new product rather than putting the money in a savings account. Aggregate demand curve is going to shift because of government spending. So as long as we're going to say that interest rates and taxes aren't changing, then an increase in government spending will increase aggregate demand. And decreases in government spending will decrease aggregate demand. So, okay, as long as interest rates and taxes don't change. So we're going to talk about this a lot more, especially when we get into fiscal and monetary policy discussions. But if, let's say here is our aggregate demand curve, which is made up of consumption, investment, we'll say, and government spending. Okay, so if government spending goes up, but they have to raise taxes to do so, then consumption and investment would go down, and the effect would just cancel out. You would get no shift. So instead, the only way for an increase in government spending to cause aggregate demand to shift to the right is if tax rates don't change. They're not raising taxes on households and businesses. How can they do that? How can they spend more money if they're not taxing? They're going to have to borrow, so the government can borrow money. The problem with large amounts of government borrowing is it often affects interest rates. And then when interest rates go up, it's going to reduce investment and consumption. So the caveat here is that interest rates and tax rates can't change, because if they do, it's going to affect consumption and investment. So this could be government spending on military and national defense, transportation projects, schools and libraries, anything that is not a transfer payment, not a financial movement where money's just going from one place to the other, where they're actually spending money on physical goods or services. And then our last category, our last component is net exports. So net exports means exports minus imports. The total value of all exports minus the total value of all imports. So if we're exporting more stuff, it means we're producing more here and selling it more around the world. So net exports going up, the demand for things produced in the domestic country is going to increase the aggregate demand for that country. If we have more imports, that means that we're demanding a lot more products from other countries. And so that would decrease aggregate demand. The exchange rate is going to play a big role in net exports and aggregate demand as well. So the exchange rate is the price of one currency in terms of another currency. So let's say I want to drive down to Mexico for the weekend. I could take my US dollars, but when I get to Mexico, I need to exchange them for pesos, right? The legal currency in Mexico. And the value of how many pesos you can get for one US dollar changes on a regular basis. Sometimes there are big changes, sometimes it's small changes, sometimes it's kind of consistent for a while, but it's not just a consistent or a constant rate. And so the exchange rate is what is the price of pesos in terms of dollars? How much am I going to get for my money? So dollar appreciation means it takes more foreign currency to buy $1. So if the dollar is appreciating in value, it means it's worth more foreign currency than before. This actually decreases aggregate demand because exports relatively more expensive and makes imports relatively cheaper. So if you have a country that has a very high level of exports, it's a really big part of your GDP, you actually don't want the value of your currency to go up because it can hurt aggregate demand. It can hurt exports and imports in your country. It can decrease aggregate demand and make your economy decline. And so some countries, such as China, for many, many years have tried to keep the value of their currency pegged to US dollars or some other currency so that it's not appreciating. They don't want it to get more valuable because it's going to hurt their export business. Or the opposite is dollar depreciation. This means it takes less foreign currency to buy $1. I can buy more dollars per peso. Okay. So dollar depreciation means that the dollar is getting less valuable. It's not worth very much. This is going to increase the U.S. aggregate demand because it makes exports relatively cheaper and it makes imports relatively more expensive. So we're going to be able to sell more stuff to the rest of the world if our currency becomes devalued. Changes in foreign incomes and foreign prices are also going to affect net exports. It affects the relative cheapness or expensiveness of imports and exports. If foreign income is going up, they have a lot more money, they may increase their demand for U.S. exports. Or if the price level goes up in another country, then they may demand more U.S. exports. Okay, and so this is relative to prices and incomes staying the same in the U.S. If it changes in one country compared to another, it's going to affect imports and exports.